What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is April 14th of 2019. Well, folks, I hope you all are having a fantastic day wherever you are. If you guys don't know already, I'm currently in Sydney, Australia, one of my favorite places in the world. So to all my fellow Aussies out there, if you could give me a like and a comment down below, I'd really appreciate it. But today we've got a lot of exciting things to talk about, guys. I really want to spend some time to talk about the macro state of where we are at the moment in markets, going between crypto, taking a look as well at traditional markets, and really understanding where everything's coming into play at the moment. So we've got lots of things to discuss. Let's not push it off any longer and dive right into the update. So seeing as we haven't been able to do a video the past few days because I've been a little bit busy traveling, we definitely have a few things to catch up on. Crypto markets over the last 7 days have been relatively in the red. This has been due to the fact that Bitcoin has dropped from around $5,400 down to around the $5,100 range, retesting back on the big even of 5,000. And we can see altcoins have been following, closing down on some of those gains we had with the recent rally. Taking a look at the market overview, I want to spend some time to focus in over the last 30 days, again, seeing how we've been able to have a massive upturn in markets and hold the vast majority of these gains. The thing that's nice about this, guys, is it tends to be that when we get these big bump ups in markets, you're going to see the vast majority of gains come down and close if there's not really any fundamental volume, right? In this case, we know that there was actual serious on-exchange buy volume. Whether this was, kind of small-scale institutional investors finally starting to stack up on positions on the open spot market, maybe because they built a position in OTC and they have an incentive now to push up market price. And it doesn't really matter. I don't think this is anything extremely substantial, but it is enough that's going to probably carry us to not only a valuation that's towards around 200 billion, but more specifically, we're going to get Bitcoin retesting to 6,000 in my opinion, and coming with a pretty sharp rejection afterwards. Now, the one thing that's very interesting here, if we take a look at Bitcoin dominance, is we're still being able to hold on this 50% mark. And what this tells me is that Bitcoin is obviously setting up to probably go to 6,000. And again, we're probably going to be setting in a higher low here. Again, we've been doing that every single time. We have the highest level here, 57. Over here as well, we've got 55%, 53.5%, and we're getting close to around 52% in this case, with other coins depleting downward. So I think a lot of the gains are going to be coming in when we do have this breach on 50, again on XRP and Ethereum. It's going to start to go into those entry-level altcoins, but we're not just there. We're not there just yet. And again, I don't think we're going to see that break on dominance until a later time in the future. So let's go ahead and take a look here at Bitcoin. Broke out of the ascending triangle here, back up to the range of 5,000, the mid 5,000 range. And what I like is even though we did have a pretty sharp sell-off here, I'll even turn on volume here, we can see that as much as it was a pretty steady amount of sell-side action in the sense of price, volume was nowhere near, at least on liquid exchanges like Coinbase, Bitstamp, Gemini, you name it, was nowhere near the buy-side activity that we had these 2 days. So it's really good to see that the market isn't breaking through that even level. We were actually able to come back up, and the actual close was above 5,000, and we've continued to regain some of those losses. Now, what's the time frame for going to 6,000? As you all know, I'm pretty confident on that. I think it could be by the end of this month, guys. With the kind of momentum that's come in, the fact that we're holding 5,000, this serious level of gains, and we're not even coming down to retest on the 200-day. This tells me two things. It tells me that there's short-term confidence, there's short-term risk-taking, but at the same time that this is going to get over-exhausted. We're making support roughly, or if you can take a look here at the RSI, we're basically making support on the overbought range. And to me, that tells me that in the short term, there's going to be continued speculation. But I don't think we're going to have enough substantial kind of risk-taking, especially with not only how fast this rally has been, but also with where we are fundamentally in markets to climb above 6,000. I know a lot of people want that. I just honestly don't see it happening. And as you all know, the reason for that is because I've talked substantially. I'm actually taking a look at the logarithmic chart. We can take a look here and see just how much it was substantial support. And as we all know, previous resistance tends to become new support, and previous support tends to become new resistance. And that was a year's worth of support, which is not good news for the bulls. It's going to be very difficult to test past this range. So again, I think we're going to get up to around 5,800, 6,000, and then we're going to come back down and I think set in a third higher low. Possibly in this case somewhere around 37 to 3,800 sometime in May, sometime maybe as well, maybe in later May or in June in this case. Again, no matter what, I'm looking for it to come down to the support line or holds on previous resistance. I'll be optimal towards the idea of buying here as well if we come back down to even just this support line around 4,200. But again, not looking to make too many serious additions. Looking to ride this up at the moment. Okay, so we've taken a look here at Bitcoin, but I do want to go ahead and take a look as well at traditional markets and price in a little bit, but we're going to go ahead and take a look through some news pieces here real quick. So the IMF and World Bank have launched a quasi-cryptocurrency in exploration of blockchain technology. Now, we're going to talk about the IMF in a little bit as well, ironically enough, when we dive into traditional markets, but in the sense of crypto, and I think the world of banking in general, you guys probably know I've been quite negative on the IMF, and I think most people on the headlines are probably selling this as something to be afraid of, something very scary. Look, guys, I'm going to kill the FUD right away. It's nothing too substantial. A lot of people use the Fed, the IMF, the BIS, these very powerful institutions in headlines when they can. They don't provide much clarification. So basically, well, they do in the article, to be fair, but again, they play the clickbait game to get you lured in. So basically, what the IMF has created is something called the Learning Coin. And as they mentioned, it's kind of a quasi-cryptocurrency that the Financial Times recently quoted on. That basically states that they're creating a cryptocurrency that you can utilize within the IMF as IMF staff to redeem for some types of rewards and stuff. And basically, you earn these coins for going through, I guess, forms of modules or education on understanding cryptocurrencies. So I think it's honestly quite nice. I would like to see the banking sector have a little bit more understanding of cryptocurrencies and as well understand the fundamentals. I think, honestly, out of all institutions, as much as I do have a very negative view on the IMF, I actually admire the fact that most of them realize the true benefit of cryptocurrencies in this case, and a lot of them don't seem to be down the route of creating central bank cryptocurrencies. Some of them realize that Bitcoin and decentralized currencies are going to play a big role in their focus, which is really emerging markets and developing economies, whether they like it or not. So anyways, again, nothing too serious there. Just thought I'd cover that because I bet some people were probably caught off by the headline. All right, so now that we've taken a look over cryptocurrency markets, let's go ahead and focus in on a major problem going on in Chinese markets and really broadly across the world. But China is well known for this issue because of the recent boom that China's had over the last few years and the financial prosperity that it's seen. As we start to look towards the cusp of a recession in China, we have to look for red flags beneath the surface. And the wealth management product market, the $3 trillion market that Chinese investors are exposed to, is continuing to not only expand, but has continued to have individual exposure, meaning that everyday consumers are the ones who are really holding these wealth management products. So what is a wealth management product, and why is this a general concern? So individuals hold nearly 90% of all of these instruments, 90%, guys. And this is a really big issue because these products, these wealth management products or WMPs, are basically fixed income markets to a sense. Where basically you're basically, in a sense, guaranteed, in quotes, guaranteed a certain interest rate or certain return on investments. This would be things, for example, maybe forms of bonds or investment packages that pay out a certain interest rate or a certain guaranteed return every year. On the surface, this sounds great, but the problem here is that this nearly $3 trillion market is not guaranteed. Let me repeat that. It is not guaranteed. In fact, the Chinese government and Chinese policymakers have been advocaately telling investors in China that this is not guaranteed in all cases, right? Not all these markets are fixed, for example, such as government bonds. And because of that, due to the fact that Chinese investors have been looking for more lucrative rates, again, you're living through this period of financial risk-taking and prosperity in China, you can see that since 2016, the individual market of investors, of average everyday retail investors, has been dominating the ownership of this market, and it's been stripping away financial institutions and corporations from owning this. Now, do I believe that it's just individuals taking this risk? No, guys. As we've seen this kind of shift from 2016 to 2018, this is very common. When you start to see financial markets get more overextended, note since 2016, Chinese equities have been going down. But along with that, financial institutions, when they're despairing their ownership of assets, well, who do you think they're selling it to? They're selling it to the people they're managing. They're selling it to the people's portfolios that they're managing at the given time. So I think that that plays a big role in this as well. And of course, this is coming at the time when regulators are saying, look, we're not going to be able to back up every single one of these wealth management products. So again, you've got a huge red flag under the surface here for Chinese Chinese assets in this case. Huge amounts of wealth that people think they have, and in reality might not have in this case, where the money might dry up very quickly. So we have to be worrying about these things, and again, keep an eye on this for Asian markets. Alrighty, going ahead to take a look again at the IMF. The betting on a soft landing, the takeaway from the IMF meetings. So the big thing that I really want to emphasize here, the IMF just recently had a pretty substantial meeting, and as we mentioned earlier, the IMF is a very imperative institution in the economic world. It is not one that I like. It is one that has a very lucrative history behind it, and not in a good way. But I do want to talk about what really are some of the major findings of the IMF here. Because the IMF, similar to the BIS, as powerful and as important as they are as institutions within this kind of conglomerate financial machine, the important thing to take away is that the IMF has to be transparent to some degree about what they're worried about and what they are optimistic about. And I can tell you that over the last the last few years since 2016, they have been getting more and more wary. And predominantly, they're showing a lot of fear for European markets. So we can see here, for example, as we take a look across the board, most European markets in this case, forecasted changes are in the negative here. And now I'm assuming this forecast here, they don't really mention, I guess, the metric here, but I'm assuming this is GDP, what they're downgrading in this case. Not to mention as well, we can take a look at manufacturing output here across a variety of economies. You've not only got U.S. manufacturing down throughout 2018 and 2019, you've got as well China slowing down, making a little bit of a rebound here in 2019, again with record stimulus as we discussed, $482 billion. We wrote about it in the newsletter. $482 billion injecting into the economy, and that's all you get in the rebound. But the biggest, weakest link here since December of 2017 has been the continued decline in European manufacturing. And it's all across the board, guys. Again, as you take a look, there's really no saviors here in the Eurozone. In Germany and France and Italy, in auto manufacturing has been going down it's been falling like rocks because Chinese markets are not buying right now. They're not buying autos at the moment. There's been huge drops in automotive manufacturing. And not to mention as well, across the board, there has been, a change in monetary policy as well. We've, again, started to see central banks tightening. And even if central banks take a break and maybe even lax rates a little bit, we have substantially higher rates here in some of the major markets in the United States. And when you start to have the World Reserve economy having an interest rate that's 2 to 3 points higher in such a fragile global system, not to mention one in which that has been building all the incentives for money to come back home, you're going to set a very strong tightening on global liquidity for developing and emerging economies. And I think that's what you're seeing within the Eurozone. I think that's what you're seeing in China and so many other markets across the world. The dollar squeeze in this case. There's a few other focuses here, but really those are the major things I'm focusing on, the drop in demand for manufacturing, slowing down in GDP. Again, these things are things that the IMF has to recognize and has to plan for because they're not playing on the game of how to make a few million. They're playing on the game on how to manage the trillions of dollars of wealth that is in the current financial system and to keep the system afloat. So we'll see if they can come up with something. Now, we're going to go ahead and talk a little bit about traditional markets and commodities, and I really want to focus in on the indicator you guys know, or the index that I know matters in this case, in this market, as it has been leading markets, and that is the NASDAQ. Now, we have been continuing to climb here steadily, slowly but surely here in April, continuing to higher levels relative to the past few months back in December. Now, I want to talk about really where I'm watching for things to make a serious move here. I'm going to actually move my arrow here. I apologize. This zone right here is what I'm looking for. It looks like we're building an ascending wedge, and this is very common in a lot of tops for markets. So what I do think is that we are going to continue climbing here and, in fact, retest the highs here and possibly have a triple top, as we've had two tops here at the range of around $8,100 on the index. So I think we're going to see the NASDAQ come up here. And ironically enough, right as we get towards the tip of this wedge here, ascending wedge here that's been showing extremely optimistic price action after an already exorbitant rally in markets. Well, what's coming up right here towards the end of April to the first day of May? Look at that. We've got the Fed FOMC meeting here, right? Okay, now we have to keep an eye on these dates, guys. These are major catalyst days for markets. Okay, it's when the Fed makes these decisions, it's going to have serious ramifications on equities. Whatever the Fed says after a rally from 6,200 points to anywhere from 81 to 8,200 points is going to be substantial. If the Fed does not roll back the balance sheet or announce that it's going to start rolling back the balance sheet and freeze interest rates, and maybe I'd even go far as to say if they don't do a rate deduction, so actually going back on the increasing of rates, if they don't do a rate deduction and they don't mention that they're going to do some form of quantitative easing that talks about buying or stimulating assets, as they've rumored to, equities are going to break through. And we're going to have a very similar repeat to what we had through October to December. I honestly believe it, because stock buybacks, in my opinion, they're not going to keep playing out. Fed, the hope in this case, the hopium that's in the market that's been carrying it forward will falter through if the Fed doesn't stick to its word, if it doesn't stick to the rumors, right? Markets are playing on a very optimistic case scenario here. Again, that's my concern, guys. I'm going to be waiting for these topping levels here. I'm going to be waiting for what was historically significant back here in September and October, and I'm going to be waiting for this ascending wedge to get to the top here. I'm not playing eager on this, okay? I want to be patient. All right, so that's the major thing I want to talk about. But interestingly enough as well, we've been talking about crypto being in a relatively positive state, I think preparing for more of the longer-term upswing sometime this summer to the fall. One thing I got to talk about is gold. Gold has been holding very nicely outside of the wedge here, making support on historical previous resistance. Let's go ahead, take this to the logarithmic chart, and just take a look at this, guys. I'll go ahead and take it to the weekly here so we can probably see a little bit of a clear picture. So take a look at this. Long-term support line. We've gotten out of resistance. We're making it support. And now what I think we're waiting for are some of these weekly moving averages to come up, find support here, not to mention maybe triple bottom here on this line of previous resistance, making it new support, getting an equity sell-off, and then an uptrend, finally, for gold markets. It's been long overdue. It's finally time, guys, where I think there's actually a little bit of risk-taking. One thing as well that I want to talk about is silver. If we take a look at the daily on silver, again, silver's in the range here, anywhere from anywhere in the $14 range per ounce. I'm eager in this case for silver. But look at how it's just holding on that 200-day moving average. Very nice to see here for silver, whereas previously we get breakouts above the 200, but it was not only in a much higher price range, we just kept breaking down. We kept going below the indicator. Now we're starting to make it support. And if we can continue to hold that for the next few months, and actually I would say just really over the next few weeks, and equities start to sell off towards the end of possibly April or early May, that's where I'm going to start getting optimistic on commodities. But until then, I'm not making any serious moves, guys. Now, do want to answer one thing that I know you guys are always watching, URA as well. Let's see what URA is doing at the moment. Not much, honestly. And this has to do with the fact that uranium spot price has been dropping. So I'll go ahead and get uranium futures here. It's a little bit of a spotty chart, but we can take a look at the UX futures here. Uranium spot price had a pretty big dip here from around the $29 range down to around $24. Now it looks like the worst has come here, at least in the short term. But honestly, as I mentioned, I'm not going to get optimistic here, guys, until we break $30 per pound here. Okay, I'm just not having it at the moment. So we got to be substantially patient. But I think there is going to be an optimistic market sometime in late 2019, 2020 for it, if we can get above that price range. Until then, though, guys, I'm not rushing into it. So that's it for the video, everyone. Thank you all so much for watching. I hope you all are having a fantastic day wherever you are. And thank you, as always, for listening in to the daily update and my rambling. I definitely want to know down in the comments down below, what are you guys keeping an eye on at the moment? What things have got you interested? Definitely leave a comment down at the moment. And if you have any comments on what we talked about today. But until then, thank you all so much for watching. I hope you all are having a fantastic day. And I will see you all in the next one. Stay tuned.